Hey guys, in this video, we're going to talk about the pros and cons of playing the same day expiration cycle, also known as the 0 day to expiration. Now, a lot of people like to play these lottos, little scalps, little day trades here and there. But the question is, do we realize what is happening when we are playing these short little lottos and scalps and day trades? Obviously you can make a lot of money of this. You can lose a lot of money as well. But people have their own certain strategies. And the question is, are you just piggybacking off their strategies, or do you actually understand the risk that you are taking? So that's going to be the main overarching question here of this video is, do we understand exactly what is happening in these short time frame expiration cycles? Okay. We're not going to get into a specific strategy or anything just like that. There's a lot of people that have their own 0 day to expiration plays that they'd like to do in SPY. You can do that Monday, Wednesday, Friday, SPX as well. People play it in the futures. But we're not going to go into a specific strategy just yet. We're just going to give a nice little overview here, pros and cons, and kind of get it into everyone's mind exactly what is happening here when we're playing these short dated expiration cycles. Also, we're doing this over the weekend, so our next expiration cycle will be the September 7th. So I know you guys were probably going to call me out on that, like, oh, you still got 2 days to expiration. Nah, it's over the weekend, so give us a break. But anyway, we're going to dive right into here. So what happens in a 0 day to expiration contract that we purchase? All right. And why would we want to do that? Well, the reason is because it's going to be low risk, high reward, or it's also going to be the reverse. Okay. So high risk, low reward, but we're going to put it a high probability of profit on that. All right, so if we're going to open up our options chain here, we'll go to our September 7th in our spiders here. You can see that we have our gamma and our delta up right now. So if we're just playing just a normal at the money delta call here, 453, currently trading for 89 cents. Delta's 46, that's fine. I mean, it's at the money, so close enough. But the problem is our gamma is very, very high. So our gamma risk is through the roof here because of this short dated expiration cycle. So the delta here is 46, but our gamma is 18. So $1 move in the stock, not only will it affect our price from the delta, it's also going to affect our delta. This gamma is going to affect our delta drastically, either it goes up or down. Also, we have volatility in here, and we're going to open up our Vega here. You can see our Vega is through the roof as well. So this will be sucked out throughout the day. So we have volatility going against us. We have our gamma risk very, very high. And if we open up our theta is also high as well in here because our time is running out. You don't have that. We only have one trading cycle to make moves in here, or else your time is up. Okay. So your theta is through the roof in all of these. So we have to be aware of this when we're playing these short dated expiration cycles. What's the trend? What's the fundamentals behind this? Why is our assumption purchasing calls? Why are we not selling calls? Why are we not selling puts? Why are we not buying puts? Right? All of this is a key factor into why are we playing what we're playing. Okay. So if we see the trend is getting ready to break, we had hard resistance. Let's just say, for example, I'm not going to look at any charts right now, but say, for example, hard resistance here at 454 for the past, let's say, 3 15-minute candles, just bam, 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 right up there. Finally printed a little indecision here off the 454s. We broke it just a little bit, but for whatever reason, we just couldn't hold it. And we say, okay, guess what? We're going to get in on the short-term little pops. We purchased the 453s here. Bam, get a nice move. About a 50-cent move in here. You get in and you get out. That's exactly how you want to be looking at playing these 0 day to expirations when you're purchasing. Okay. You want to make them short and sweet because it's going to be low risk, high reward. It's only going to cost us 89 cents. But if we get a drastic move right off of those 454s or something like that, then we could have ramifications of having a nice big profit in here. The problem is if we do not get those moves, well, guess what? Our theta is through the roof. So that's going to kill us. Our Vega is through the roof. Our implied volatility is going to get sucked out. Our gamma is also very high. So if the stock goes against us, well, guess what? Our rate of change of our delta is also through the roof as well. So we're losing a lot of money really quick. Now, when we're selling options in a 0 day to expiration, well, everything is in your favor, but the problem is this gamma is still really high. Okay. Because you might think, well, Okay, what I'll do is I'll go over here. I'll look at my volatility. $2 expected move. I'll just come in here and let's see. I'll sell this 455 call right here. All right, it's only trading for 15 cents, but I'm going to sell it anyway. That's an easy $15. Well, not necessarily, because your gamma is so high that your rate of change of your deltas are going to change drastically. And when that happens, also volatility may be kicking in here on the upside, and that's going to affect your options as well. So, and I guess the biggest thing is you're not making a whole lot of money, right? You're only doing this for $15. I would rather pay you $15 than to sell a 0 day to expiration undefined risk for 15 cents, right? So that's especially in a low IV environment like we are now. So that's kind of what you have to look at when you're looking at selling anything 0 day to expiration. It's always going to be, you're not going to make that much money as far as profit wise. Okay. Not unless you're doing multiple lots, right? You got like 10 tranches on in here. And you're managing manually, you're just looking right at this. You know what I mean? Any move, you're right on it. But if you're just in here just trying to sell something, your profits are going to be limited. Your win rate's going to be through the roof. So your win rate's going to be really high, but excuse me, your win rate's going to be really high, but your max loss, your max drawdown is going to be very, very high as well. So it's kind of pick your poison. Would you rather purchase a call and your only risk is 89 cents, but you have time, you have gamma basically. I wouldn't say it's going against you, but you have to be aware of that if the stock goes against you. You have Vega going against you. You have your theta going against you, right? Would you rather have that, or would you rather have all of those in your favor? With a high win rate or a low reward. So that's sort of the questions that you have to ask when you are playing these. And like I said earlier, I do a 0 day to expiration trade in SPX Monday, Wednesday, Friday. But that we're not going to dig into that certain strategy just yet. But I'm just kind of giving you a little overview here of exactly what is our risk when we're looking at this. And so remember all these, I wouldn't say remember all the numbers here, but just kind of remember what we just said here: high gamma, high vega, high theta. If we go out and we give ourselves time, even if we go out 12 days, right? We go to the September monthlies. Well, guess what? Look at our gamma. It's already down to 5. All right. We go to our vega, 37. We go to our theta here. It's at 9. So you're not getting beat up a whole lot in here from these further dated expiration cycles. And even if you go all the way out to your October 15th, right? Your gamma super, super low in here. So these are all things that we need to keep in mind that will affect our options in those shorter dated expiration cycles. The longer ones, a little bit safer, but of course, more expensive. And you're going to have to wait a little bit longer to make the full potential profits on here. So do you want to realize your profits quicker with more risk? Do you want to realize them slower with less risk? Do you want to pay do you want to pay a little bit of money? Do you want to pay a lot of money? It all comes down to your risk profile. And you also have to consider other factors in here, and not just, hey, guess what? I think SPY is going to go up, so therefore I'm just going to buy the shortest dated expiration cycle in here, and I just hope that I get a nice move within that time frame. So again, just kind of keep all that in mind before you place a 0 day to expiration. Even sometimes somebody will say, hey, this is going to be a lotto, we're going to be in here. Well, guess what? If you're not comfortable playing that lotto, even though it's very cheap, 30, 40 cents, maybe $100, you can go out to the next expiration cycle just to buy yourself a little bit more time. It's going to be more money, but you can buy yourself time, make it not as hurdle. It's going to give you more time to kind of massage losers into winners, kind of manage however you would like, excuse me. So it's all up to your risk profile and what your underlying assumption is on that specific stock. So again, basically overview, it all comes down to your risk profile, and it all has to do with your time, your gamma, and the volatility in here, and again, your risk and your reward. Okay, guys, thanks for watching. Make sure to check us out on our social media. We have attached the links to our socials in the description, and we also have a trading service if you're interested. There's more information in the description below.